Welcome to our Beginner's Guide to Financial Forecasting for your new business. Developing a solid financial forecast is crucial for planning and managing your company's finances. In this step-by-step guide, we'll walk you through the process of creating a financial forecast. The first step in financial forecasting is to set your goals and determine the time frame for your forecast. Identify what you want to achieve financially and consider whether you'll be forecasting for the short term or long term. We have created a financial forecasting workbook to help our clients visualize their future finances and form a clearer picture to reach their financial goals. In this workbook, you will need to estimate your revenue. Start by analyzing your market, competition, and target audience. Based on this information, make reasonable assumptions about the number of customers, sales volume, and pricing. Break down your lines of revenue by product or service categories if applicable. To create an accurate financial forecast, calculate your costs and expenses. Consider direct costs like materials and labor and indirect costs like rent, utility, and marketing. Account for fixed costs. These are constant regardless of sales volume, and variable costs, which change with sales. Also, factor in any one-time expenses or startup costs. For example, personal costs can be things like food, gifts, health or medical supplies, home, transportation, personal, pets, utilities, travel, and debt. And business costs can be things like rent or mortgage, materials, technology, utilities, advertising, website, employees, and insurance. Some of these will more than likely change from month to month. The initial month may have a higher materials and technology costs due to having to buy one-time startup items. Personal costs will also fluctuate. Like gifts, you may know you have someone's birthday coming up, holidays may be close, your anniversary may be near, or you may have increased travel expenses from month to month due to planned vacations or traveling home for a holiday. You can even project costs like this to paint a more accurate picture for yourself. You also want to determine your operating expenses, such as salaries, wages, insurance, office supplies, and professional services. Be thorough and include all necessary expenses to run your business effectively. Categorize them and assign reasonable estimates or actual costs based on research or industry standards. Now let's project your cash flow in each category. Consider your revenue estimates, costs, and expenses to forecast your cash inflows and outflows over the specified time frame. Account for timing differences such as delayed payments from customers or extended payment terms to suppliers. The workbook also will create a profit and loss statement for you each month. This is a key component of financial forecasting. That statement is shown at the top of each month in the workbook in the monetary net profit or net loss statement, and a percentage is calculated based off of the previous month's end balance to show a statistical value of increase or decrease in profits. It summarizes your revenues, costs, and expenses to determine your net profit or loss. Project your P&L statement based on your revenue estimates, cost calculations, and projected cash flow. It is the difference between your revenue and combined costs. There is also a total net profit sheet at the end of the workbook that calculates your total costs and total revenue income over the entire time frame of the forecast and your total net profit. A balance sheet is also included in the workbook. This provides a snapshot of your business's financial position at a specific point in time. It shows your assets, liabilities, and equity. Project your balance sheet by estimating your assets on the asset sheet. These are things like cash, inventory, and equipment. Estimate your liabilities and equity on the liabilities and owner equity sheet. Liabilities are things like loans and accounts payable, and equity is things like owner's investments and retained earnings. Once you've completed your financial forecast, it's essential to review and revise it regularly. Compare your actual financial results with your forecasted numbers. Identify any gaps or discrepancies and adjust your forecast as needed. Regular monitoring and updating will help you stay on track and make informed decisions. Financial forecasting provides you with a roadmap for managing your business's finances effectively. Planning, preparation, reviewing, and reflection can lead to financial freedom. By following this step-by-step tutorial, you can create a comprehensive financial forecast that guides your decision-making and helps you achieve your financial goals. SOAR Innovation Team has created this easy-to-use financial forecasting workbook that includes monthly transaction logbooks for you. Reach out to me, Casey Hicks, SOAR Innovation Startup Engagement Coordinator, to review this document and set out on the road to success today.